everyone. And I have with me today Sanjay Nath, co-founder and managing partner of Blume Ventures. Blume is one of India's best known early stage funds. Blume has been at it as long as anybody in the industry has, and the pioneer of the VC model in India. Sanjay, first of all, thank you so much for joining us here.
Thank you, Sriram and Joji and the team.
Sanjay, when I talk to VCs and founders here, the first question that everybody asks, and without even being prompted is of what the hell is going on in the market, the kind of rounds we're seeing, the kind of valuations we're seeing. You're at the heart of the action. You've been in the valley, you've been meeting LPs, you've been meeting other investors. What's the sense there?
Sure. I think it's great you cut straight to the chase. So, if we, Sriram, if we wind back a bit, wind back the clock, let's say to March 2020, I think after the lockdown happened, there were a lot of investors in the wings and also founders waiting, right, for this thing to cool down or settle down. Interestingly, obviously on the health side, a lot of our friends and the whole community has suffered and it's still tough. On the digital side, though, the second order effects have been that this has been a tailwind, right, for all things digital. I mean, today, every corporate has a digital strategy officer, and it's been a tailwind for VCs. So what happened after some time was that the investors and the market just saw, for example, our own an academy take off and become a unicorn, right? You saw learning almost move virtually. So investors basically said that this is not going away. And secondly, it is a boon for all things digital. So we're just going to jump in, dive right in, right? So the other point is that also today, one can build global startups from anywhere, right? I know we were just talking about before the panel how this panel itself is. I don't know if any of us are in the same city, on this sort of wide panel. So the second trend is that at least Indian founders want to build global from day one, even if they're building for India. They want global best practices. They want a global cap table. So when you use the word crazy, I think what is happening is it's all about growth, scale, and momentum, right? So I think startups and the investors are saying, hey, do you, the average seed round, which was about, $500,000 or $1 million, maybe 5 years ago, today is at least 2 million, right? Plus minus, give or take. And your Series A, which about 10 years ago in India was, 3 to 4 million. Now people talk about small Series A's or real Series A's of at least 10 plus. So I think the fact is that, and the third part is that look at the public markets, right? Here in the US, you have Datadog and Snowflake, which did really well. But back home in India now, Zomato did extremely well, and then you have Freshwork just from a couple of days ago that went public. So because the public markets also rewarding those kinds of companies and multiples. I think that effect is, bubbling down to the market, and it is a crazy market in that sense where all of us, right, including Blume, have to just be, extra value added and move fast, and also just be more thoughtful investors. So it is actually, like we say, I mean, we always say it's a great time to be an entrepreneur, but today, absolutely.
It's interesting you say that, Sanjay, and I mean, but would you qualify it when you say it's a great time to be an entrepreneur? In some sense, it feels like a tougher time to be an entrepreneur because you have to be a lot more responsible. The amount of money that's available is very easy to chase short-term behavior, short-term motivations. You can always say, we'll build later, we'll look at profits later. And looking at profits later is a legitimate strategy. A lot of people do that. But the flip side of that is you don't know where you're going. You can get blindsided by anything that may happen. You end up taking more risk than even you may perceive.
No, it's a great question. It's like a superhero quote, right? I mean, with great responsibility comes, or rather with great danger and opportunity comes great responsibility. And this responsibility, Sriram, not just in terms of money, but also in terms of your own people, right? I mean, think about it. We're still not out of the woods at all, right? In India, people have been bracing for a third wave, touch wood, that's not happened as yet. The world is still not got out. So you're also responsible for your people, right? You're responsible for your stakeholders, not just the capital. It's your senior team, your new members, your young team, your own family, families of your team members, right? That's also a lot of responsibility because you're hiring. It is not unusual where startups have, in some cases, startups may not have met their co-founders that often, correct? Let alone the other team members. Now, when it comes back to capital, I think you're right. there are two kinds of investors, right? The one is that say, okay, here is 20 million, and here are the milestones, and as long as you get to it, doesn't really matter. We don't need to take a board seat. And then there are other investors like us who say, okay, this is the path, but there has to be a reason to raise capital, right? It can't be because you just want to get rich quick or whatever. So I do agree with you. So, I mean, we like to do clean term sheets, but there are so many ways, right? You can do two tranche, you can do milestone based tranches, right? If there's a 10 million, you can say you don't need the 10 million upfront. Maybe you hit 4 million and hit these goals, because you know how it is, right? I mean, whatever you raise, you're going to spend. It's like just like being a errant teenager, or what you will. I do agree with you. You have to have responsibility. And that's where you've got to stay away from the herd mentality, where we also have to be responsible, right? Because we are the ones giving the capital. So it's always that balance, I think, of, leadership and achieving growth and momentum and giving too much too soon. So I do agree with that. And we've always been more careful investors, right? I mean, of course, we're delighted when larger growth investors come into our rounds, but we are not, it is not capital for the sake of, and every deal and every capital raise is a case by case basis.
But Sanjay, when I talk to people here, founders, VCs, bankers, there's an eminent sense that, something unexpected or something special is happening. When you're in the US and you're talking to people, do you get that sense? Because the US has seen this up and down, A, more times, B, at a larger scale. In India, just 20, 22 billion coming into internet startups, and it's just September, nobody could have guessed it. When you're talking to your LPs and when you're talking to your other investor friends, their founders, what is the sense there? I mean, are things more normalized there, or even there, is there this sense of, this is wild, this is not normal?
Sure. So, I'll just say that it just happens to be, I mean, it's happenstance that I'm sitting here right now in San Francisco, but I am, 100% selling, marketing, and wedded to India, right? I mean, it's just that my vantage point, my perch is different because I'm observing India from here, and I'm back soon. No, I think, see, it's really interesting that the venture and the startup ecosystem between Bangalore and Silicon Valley, or, wherever it is, Boston, New York, is much more inextricably linked than, let's say, India private equity or public markets, right? Because we speak the same language. Our cap tables are common. All our B2B founders are going after global markets. They're large global investors coming to the top Indian consumer companies, right? So it doesn't really matter in that sense where you are. We were just talking about it, where people are building from. There are some startups that have been building from different parts of India also, right? It's not, I mean, Goa, for example, has become a hub for talent. I know there has been not an exodus, but there were a lot of people who chose to work from home, and from Bangalore, the co-founders remained, but the rest of the team moved to other parts, right? To their hometowns, and they've been building the headquarters are Bangalore based with their way. It's pretty much the same. I think what is happening is, see, what Sriram, what India didn't have was, we didn't have enough exits, and we didn't have enough, let's say, not necessarily millionaires, but you saw that happening with Flipkart. Now we're going to see it with Freshworks for sure. You want, a base, an army of people outside who are going to go out and take risk, right? Who have made some money and then say, with this extra money that I have, I'm still going to lead a semi-frugal life. I don't need to splurge money, and I want to take that risk, that I've been thinking about for a long time. And the senior folks become advisors, mentors, angel investors. The junior folks go out and they look to senior people to back them, right? So I think that is the core, right? Which is why the Valley took off, because it's the Zooglers, right? And Facebook employees who went out and started businesses and then got bought. And it becomes what you need is a network effect. You need a cycle. So when you use the word crazy, I think crazy is, yes, in terms of valuation, sometimes you find that, you suddenly, on the basis of limited due diligence, you got a 2-page term sheet for a 20 million check or 100 million check. That is crazy. But I think the aspirational entrepreneurship, the fact that, today an academy has become a leader in EdTech. GreyOrange is becoming a global leader. These are not just India leaders, global leader in warehousing automation. That unbridled enthusiasm and entrepreneurial ambition is something fantastic to see. That's why I said, right, when you see an entrepreneurs, some people have sometimes remarked to me and say, Indian entrepreneurs are Indian entrepreneurs ambitious? And I said they're super ambitious. We have to actually rein them in. We've got to say, hold on, take it a little slow. You're going to get there, but don't go that fast. Go slow. So I think it is always that balance. What is great is now delivery is going to go public, right? That's news. It's fantastic for the ecosystem. We just have to temper it and make sure that that aspiration is always there. But to use your word, I think that you don't go crazy. You're balanced.
Fair. Also, Sanjay, at this time, how do you look at things from a fund manager's lens? Because as of today, I'm sure most of your funds are looking brilliant. The more recent, probably the better they are. The IRRs will be looking spectacular. Now, when you calculate IRRs, you make some projections on how things will look, and say you plan another fund and you plan the construct around that. How do you do that during a market like this? For example, do you have to factor in that your fund three's IRR may be looking fantastic, but some of these may clearly not sustain, and that's an assumption. I'm not saying that's the case, but that some of these, these are bull market valuations. We don't know where they will eventually settle. Do you have to do that kind of math, or do you just go with where the numbers are?
I think it's a great question. I mean, it's a good LP question. If you think about it traditionally, again, if you go back to about 10, 20 years, traditionally, in terms of relative advantage and allocation of dollars proportionally, China was always a little outweighed, right, relative to India. I know you have quite a global audience here, right, in Singapore, Southeast Asia, China, and India, and of course the world. Because one of the outcomes, desired outcomes that were not happening enough was actually cash on cash exits, right? So in our business, they're called, it's called mark to market or up rounds or marks, right, if you will. And then the others cash, right? The cash on cash, DPI, the actual distributions that are delivered, right, to LPs. And that second part hadn't happened. Now you're seeing it happen more and more, right? I mean, if you look at the Zomato IPO, right, from the earliest angels to pre-IPO investors, to everybody's had, share in the pie and got that. So I think to your point, I think it's again a balance, right? If let's say you're raising a third fund or your fourth fund, then you can't just have marks from your first fund and second fund. You actually have to have cash, right, that you delivered. Because think about it, right? I'll give you a practical example. If an LP is going to give you 10 million and you've taken that 3 years ago, not 3 years ago, 3 fund cycles ago, right? You're looking for a fund 4 and they've given that to you in fund 1. And they really like you. They love the fact that you have marks and that you're in a lot of unicorns and you're known as the go-to VC. The best way for them to give you money back is that if you've made that 10 million, 30 million, right? And return the 30 million, and then their LP portion for your new fund comes from what you've distributed back, right? So they don't have to go for fresh allocation. It's very simple, right? You've returned 3x, 3.5x, just as an example, and the new allocation is coming from what you've returned. So I think it is a fair consideration, because how much can you just have marks? This is a volatile business, right? While we are not like stock markets, I mean, you never know. There could be regulatory factors. There could be key man factors in the founders. There could be so many things. So you have founder breakups, you have founder fights, you have key people leaving. You have to, sometimes take some money off the table. And again, do it in a balanced way, right? Like, so everything about our business is nuanced. It's never do a full exit or stay in, right? You can return principal, stay in for the upside. And I think it is important. It is important because what you want to do is you want to create a cycle that that just becomes virtuous. So every 3 years you're raising a fund, but you're also returning the prior funds, right? You can't just do one. Doesn't exist. One can't coexist without the other.
Correct. And Sanjay, when you also look at where Blume is going for say the next 2-3 years, how do you see that? Because when Blume started, and I would say even till a couple of years back, Blume was almost seen as the underdog. Because you were a homegrown fund manager, you were in some sense up against the Sequoias, Accels of the world, although check sizes were different, etc. But you were someone trying to build a homegrown VC brand. Today, as your fund sizes get larger, you're almost the incumbent. A lot of founders know who Blume is. I'm sure you get the kind of deal flow that most of the other good funds get. How do you stay nimble and still stay disciplined today?
No, great question. I think like we are all organisms, and so is the venture ecosystem, startup ecosystem, and we all evolve. It's really interesting. I mean, when Karthik and I and we added the team and we started way back after we met at the Mumbai Angels. You're absolutely right. The first fund was all of 15 million, 1.5, right? 100 crores. We were the first homegrown fund that had raised 100% domestically only, because as you know, ventures been heavily backed by overseas investors traditionally, right? And of course, now we've grown to that. And that space that we started with, as you pointed out, has itself become a separate opportunity, correct? I mean, you have for Sequoia itself, Surge is its early stage vehicle. Of course, it's quite a large fund. You have quite a few incubators, accelerators, angel networks that have also become, Indian Angel Network has its own fund today, right? So that space that we started with has been vacated and filled by, lots of others. Um, I think we're constantly innovating, we're developing. You'll see some more when we finally do, when we finally finish our, the final close for this new fund. We're trying a lot of interesting experiments and initiatives. I think the broad point I'll make for Blume and for the others is that all funds and fund managers and VCs have to know who their core is, right? For us, early stage is in our DNA. Now, what does early stage mean, right? So for example, when you meet people in the Valley, I tend to see a lot of investors who are domain experts but stage agnostic. If they're doing enterprise infrastructure or application B2B enterprise, they can come in pre-A and seed, and they can also do like pre-IPO, right? They tend to be more stage driven. More sector driven, not stage. We see ourselves as early stage. So what we've done is, as you know, we set up Arca Venture Labs, right, with two Valley VCs to basically just double down on the cross-border innovation that was happening, with Emergent Ventures and with Benamo Global Ventures. We were also part of the Draper Venture Network because we wanted our early stage companies to have access in the Valley to corporates and CVCs, corporate VCs, and people like that. We've announced, I think, the Blume Founders Fund, which is, for alums and for sometimes you see a very plan on paper, which is pre-product, pre-revenue, and you want to back it. So trying different experiments. So for us, the challenge and the opportunity is always how do we stay relevant and very early, but yet as the market has changed and your seed rounds itself are expanding, today, and Sriram, I'd love to hear your views also. I think, at least a mil, right? I mean, most founders who are starting with their salt, he or she at least wants to raise, sometimes 1 to 2 million. So you've got to be able to participate and help founders at different ends of the spectrum.
That's fair. Sanjay, when I've also spoken to VC fund managers over the years, and when I asked them about their fundraising experience, the fundraising experience is a rather short-lived one. They always say LPs are asking for exits, and we have to show exits at some point. The conversation almost always boils down to that. Today, when you've gone to raise a fund, for the first time, you can say, look, here are the exits. On an ecosystem level, here are the exits. On a secondaries level, these are the secondaries that can happen. Does that finally sort of arrest the conversation? Do you finally have an answer to the, ever-pervading question?
So, I'll say this. I mean, a lot of your audience also, maybe LPs, maybe GPs raising LPs. I'm saying this in half jest. LPs always find reasons to either support you or not support you. Whatever you have, they'll have a counter argument. So you can, you can say I have a lot of exits, and say somebody may say, who asked you to exit, right? We wanted you to make this a decagon, right? And why are you leaving? Why did you leave money off the table? You exited too early. Look at this, right? I mean, you could have a Snowflake or Salesforce come and buy you, like how they bought MuleSoft. So I think it is again a balance, and you have to have allocation right across, right? When you look at our exits also, you don't necessarily exit all of them. So what I will say is this: it's not just exits, but I think it's the scale of exits is important. I'll give you an example, right? This is like partly public knowledge. When we had I'll just give you approximations. From our first fund, we had Zip Dial to Twitter, right? And then we had Taxi for Sure to Ola. We're looking at a couple of more. So there's a difference on sometimes what is a great exit. Is it a great exit, and is it a great story, or can it be both? So sometimes you have a great acquirer coming in, and the exit value may be good, not great, but there is a very interesting story. It gets you into a Fortune 500 company, or the founders, are going to go there and work, and after they lock up, they'll come back to you and you fund them again. So it is more a better story than a great exit. Sometimes you have a great exit outcome and that. I think what LPs are looking for is a mix, and it's not like saying, oh, there were no exits and now give us 10. But what they're seeing is, you have So we over-index sometimes thinking about entry valuations, right? We spend time on term sheets, and we don't spend enough time on exits. So we have a capital markets team today in Blume. We decided to bring in Kunal Bajaj, who was a fintech entrepreneur himself. Started a company that was acquired by MobiKwik, and he's also an investment banker. Because I think as an industry, you're right, we don't spend enough time thoughtfully thinking about exits, right? We spend so much time on entry. You have analysts chasing a deal, partners spending time with it, sometimes for a $1 million check, but you have a potential 100 million exit outcome and you don't spend time on it, right? That's why you have to sort of coexist. So I think what LPs want is they want that orientation where you're thinking about it like a cycle. You're spending time on the new breed of entrepreneurs, but you're also returning the earlier funds. And I think the scale of exits, Sriram, is very important because it's not just the number, but the scale. That can India produce, unicorn exits, right? Can you return the fund, right? Which is drag into the fund. Can you return? Small funds have the advantage they can return multiple times the size of the fund. If you're 20 million fund and you're sitting in a Zomato or a Snowflake, your fund itself could be 8x, right? Larger funds have the issue because your return 200 million fund. I mean, to return 2 billion at 10x is extremely difficult. So
Correct.
yeah, so it's changing. I think LPs are happy with the greater exit orientation of most GPs.
Sanjay, when I also look at VCs in the valley, the early stage ecosystem there seems far more innovative. There are so many fun structures. There are solo GPs. There are people who do, there are also massive seed funds. There are 600, $700 million seed funds. Again, like I said, solo GPs, entrepreneurs moonlighting as VCs. Do you think some of these will come to India? In India, the early stage VC model has been for the most part standardized. There are exceptions here and there, but for the most part, it's been standardized. Do you see that kind of innovation in the Indian ecosystem?
Yeah. One thing I will say is that we have to remember, there's always the value overhang, right? I just happen to be sitting here, but we always tend to sort of come back and compare things to. And the fact is that it's more than 50 years old, right? It is an old industry. It was invented. I mean, the folks who invented are now all chairman emeritus of their respective funds, right? Whether Sequoia or the others. We're fairly new. I think when I came back in 2010, 11 to India and Karthik was already back, one would always ask, like, am I too late to the game, and say, wow, all this has already been done. But you realize that it was all of 10 years old, right? I mean, really kicked off in the 2000s. I will see, because of the volume and the valley being the epicenter, you will have it always as a source of innovation. But I feel that India has become very innovative. I'll give you some examples. In our own case, you're aware of SPVs, right? I think SPVs for deals by deals, quite a few VCs do it. We have been doing it. That is not a new innovation per se, right? That is a simple practice of following your winners, right? The power law. You have a company that's doing well. You have a small fund. You have pro rata. You can't support it. The founder really wants you at the table, right? The founders come and tell you and say that, hey, I love the value you're adding. This new this new investor doesn't take a board seat. We can't even reach them. We want you to stay in. So those are SPVs. And we went and set up a couple of opportunity funds, right? Opportunity funds are basically you see your winners emerging. You still don't have your pro rata. You have a small prior fund, and you say, let's package, a couple of securities, couple of companies together, where you still see there's going to be value. You believe in the upside of the value, and your LPs like it because now they can cherry pick, right? They're not looking at a index fund and blind pool. Is the opposite of a blind pool, which is they can cherry pick. So they like that. So you have opportunity funds coming up. Then of course you have venture debt. Now today you have venture debt funds. I mean, you could. I don't know if you'd call venture debt an innovation, but earlier we just had one. Now you're seeing that mushrooming, right?
That's true. That's a fair point.
So
I take
you
your point.
have SPVs, opportunity funds, all of that. You do have rolling closes. I think we don't have as many solo GPs, which is correct. But Sriram, I also have a counter view. I think there are also, we live in a different world. I think everybody here on the call, including Joji, we're all, I think, in 5 different cities, okay, as we speak. But I also I have a counter view where I think what we are missing is, for early stage, especially, I say this again, sometimes a cliche, that we are in a people flow business. We are not in a deal flow business, right? We are in a platform and a relationship and a people business. Is not just about, of course, we are in the money business, but that money comes because you're backing the right people who are changing the world. So I think we've missed out that in person, right? No thanks to the pandemic. So I see on Twitter sometimes, in terms of when you talked about innovation in the Valley, I see this Twitter verse with Valley VCs very proud saying, I've not met my co-founder in my Valley VC. I've done 20 deals in the last 20 years, and I've not met any of my portfolio founders. And my portfolio founders are working entirely remotely, and they've all hired all their teams remote. Great for them. But I don't think that's the real world, because this is a marathon, this is not a sprint. How do you back
It's
somebody
not
if you have
sustainable,
not met
right?
them for 2 years? No, it's not sustainable. You don't know the real person, right? I'll give you an example. If you and I were co-founders, I can't see the dynamic between the two co-founders on a
By
Zoom
the way,
call, right?
Sanjay, I'm so
Uh,
sorry to interrupt. We just have a minute or two to go. Huh? So you close this and we'll
yeah.
be done.
No,
But you can
so
finish.
absolutely.
You can finish.
What I wanted to say to punchline is, I think India will be at the forefront of innovation, because I think our ties to the valley are so strong. It's one world today. Earlier you could say it was the valley India. Today it's all interconnected. So I think we're innovating a lot in India, and of course we collaborate a lot with our peers and VCs here.
Got it. Okay, I think we have just a couple of minutes more. I'll just do one more question.
Sure.
Sanjay, is it in this era of easy money and high valuations, does governance also become more important? Because it also looks like a conundrum where you've got a portfolio company whose valuations are rising very quickly. He's getting other investors on board. How can you still hold him accountable? He's giving you your markup. So from your standpoint, you're doing very well. But if the company is being unethical in some way, if there's some governance issues, if there's cultural issues, how do you address that?
Absolutely.
Especially
It's a
when the
great
founder
question.
can say, I'll just complete. The founder can say, I'm giving you your markup. You should be fine with whatever. It's my company.
So I absolutely, I think it's a great question to wrap this up. See, I think a markup is not a end outcome, right? It is a case in point. It's a point in the timeline. So ultimately, LPs don't care about markups. They're going to say, okay, tell me, I want to see the full journey of this company, not just one markup. Markup is a snapshot, right? Markup is a snapshot, a case in point. Governance is very critical. Governance becomes even more important when it is accompanied, to use your words, easy money, right, and high valuations. Now, at Blume, Ashish, our third partner, and we have a shared services arm called Constellation. We do outsource CFO. We're like outsource CFO for our companies. We help them with financial due diligence, compliance. We are on the board. Who's asking questions about burn, about whether we're staffed, about the right hires? You don't want to throw money. I'm not saying founders throw money, but that's also, I think. So I'll wrap up by saying it's not about them being responsible. It's us being responsible to ourselves first. Then we are responsible to founders, and then to our LPs, right? We have a fiduciary responsibility to ourselves, to our LPs, to our founders. We have to play that role, and we build a platform to actually support that. I think it's a great question. It's even more important in today's, because if you have extra easy money, like you said, then your bar for governance has to be even higher.
Correct. Correct. But does there also have to be a passing of the baton, where when other investors are coming in and they may get larger stake, you may get diluted at some point, and then your information rights, etc., may be curtailed. So whether you like it or not, you also have to count on the other investors to do whatever governance measures there are to be taken.
Sure, great question. Very quickly, I think this comes back to relationships, right? I think and branding and reputation. I think for the other peer VCs and larger VCs that know us, right, will actually sometimes come and say, "Hey, listen, you are falling to 15% and we are 20%, but we know the value add on this particular aspect, right? We would like you to stay involved." Founder says, "Of course, we'd like to." Founders can play it both ways, right? Sometimes they want you to be involved, sometimes they want you to be less involved. The other growth investor says, I'm sitting in the US, I don't take a board seat. I would like you to play a role. I'll tell you, there have been investors who have actually told us that we would like you to help us represent our rights. Let's combine them, right? Because we came here to the table because of you, and we look to you because we're sitting in the valley. We can't really be on the ground in India, so they actually welcome it because your interests are aligned, right? It's one company. You have a stake in the same company. It's not two separate companies. It's the same class of shares. So they actually welcome it.
Correct. But I think that's it, Sanjay. That brings me to the end of my questions. Thanks a lot. This was an absolute pleasure. I think it gave us a lot of insight over just what the venture world is looking right now, especially when nobody knows what it looks like. There are a lot of disagreements over where it is and where it'll end up going. During that time, it was great to get some perspective from you. Thanks a lot.
Thank you. Thanks for having me. Have a great event.